Hello, my name is Gary Keeker. I am with LifeLongU, and this tutorial is dealing with financial budgets. It's one of many tutorials that LifeLongU will be creating and offering out to its clients. What this budget is the result of a book called The Richest Man in Babylon by George Clason, a combination of Financial Peace University by Dave Ramsey, and the Excel spreadsheet created by myself. And what I did is listen to those books and their conversations and wanted to create a quicker way for an individual to actually get a budget created on their own. So this budget is it's pretty fast, and it goes through your income streams and different types of expenses that anybody may find themselves um, in different types of categories. So I'll just go ahead and start with this and see where we go from there. We start out with the income streams for an individual, and this spreadsheet is broken out into income streams is the first section. The next section is gifts to God, our church, or any other affiliation, but we believe first in giving to charities, to others. Next, we are paying ourselves, and we continue on down the spreadsheet, and we pay for our living expenses, and then we finally pay our creditors last. So there are 1, 2, 3, 4 expense categories that we classify, which summarize at the bottom of this spreadsheet too. Our gifts total, savings total, living expenses total, and then creditors total. So let's begin. Let's say that we have a husband-wife couple that are managing a budget. Um, the wife is making $85,000 per year, and what we do is any of the yellow cells are cells that you can type into and are requiring information to customize your little budget here. So what the spreadsheet does is does the math for you pretty quick. So we look at $85,000 in column F here, and that automatically, as you can see, breaks out, adds up annually in this column, and then column E breaks it out monthly. Off to the right, we're also doing one more. In column J, we're breaking it out in weekly earnings, just to get another descriptive view of what our monies are that are coming in. And let's say that the husband is he's making 65,000 a year. So for a total household income between the two salaries coming into their home is 150 grand. That totals up on top, and you can have all kinds of different incomes. Maybe they're getting a little bit of trust money, or maybe there's some kind of annuity paying them, but you can add that in as well. Or if someone's working more than one job, whatever. What it does here in columns G and H is a little red notification saying to please allocate your income and expenses using the yellow cells below. It wants you to go ahead and itemize how we are spending that money. So our first step is to gather our earnings and record it in the screen section up on top here called income streams. Those are our inflows. And LifeLongU believes in tithing and giving to the church, giving back to God, or giving back to individuals that are in need. So we start with that. And again, you can, however your belief is, how you are giving back to whomever. If you choose not to, that's up to you. But for the sake of our tutorial, we are giving and believe in tithing, and tithing is 10%. So what we are doing now is we have our 4 categories of expenses, the first one being giving to God, and we are saying that out of the 100% of the $150,000 of income, we are going to give 10% of that to these two categories. The first one is church. Let's say we give 75% of this 10% categorized amount to the church, and the remaining is other types of charities, which we will, or whoever can be, um, heart, cancer, um, homeless, shelter, however you want to give out your money, that's up to you. But here it just automatically, as we put these category percentages in, it breaks it out and gives you a rough estimate. Well, this isn't exact, but it gives you an estimate of your budget of what you intend to give in the way of charities. The next section is pay yourself. After you've given to charity, you should make sure that you are paying yourself. After all, this money is your money, and the earnings that are coming in is your household money, and you decide what happens with it. Although you may have obligations and commitments that are pulling that money or are in need of the money, like a mortgage, for instance, or a car payment or something like that, the money still is up to you whether or not you choose to pay for that or not pay. Obviously, if you don't pay, there's ramifications of that. So as we go through here, we want to make sure that you actually are also one of your own creditors. You want to pay yourself. So don't forget that. That's an important step. So first we give to charity, then you give to yourself. And when you're paying yourself, Mr. Ramsey does a very nice job of recommending that, first of all, your first savings goal should be to save $1,000 as quick as you possibly can. So I see I don't have a yellow cell connected here. We want to get rid of that. This yellow cell here should be not less than 10%, but really what we want to do is give ourselves at least 20% of our total, our paying yourself, because that 20% is important for you to actually um, paying yourself first builds self-esteem in yourself. It builds security. It gives you the ability to have cash to do certain things. It gives you an emergency fund. All of those, Mr. Ramsey does a nice job. Like I said, over here, goal one is to save $1,000 in an account as soon as you can and try not to touch it. Second goal is to save $15,000, which would eliminate the need or necessity for emergencies, whether it be medical or auto repair or your furnace breaking down. It needs to be sizable amount so that you can tap into it in the case of somewhat light but still major catastrophe that you or emergency that you may need some cash. So those are our first two savings goals. After that, we have a 401k plan. We would recommend you putting money into that if your employer has something like that set up, mainly because of the matching possibilities, and it could be a 401k profit sharing contribution plan where they're matching either profit sharing or they're matching 401k whatever you put in. So you want to look into that, and then go into IRAs and any other type of investments which you can add into here as well. But again, I am not a investment advisor, and you will have to go and seek out that advice from those professionals. So if we do that, like we did above, put the 20% in to pay yourself, we still need to allocate that. So let's just allocate 5% here. And again, this savings total always needs to be 100% of this 20% for each category. We want to make sure we get it all allocated through the yellow cells. So savings goal 2 here, let's go another 25%. Let's just jump that to 50. That gets us to our 15,000 over here right away. Then 401k, let's do 25% there. As you can see, we've allocated 80% of that so far. So let's just put the remaining 20% into an IRA. So now we have 100% of our 20% of paying ourselves category allocated. And these are the dollar amounts. So that $30,000 of our $150,000 up here has now been allocated. And what that section also does, it takes a quick look at some rates of return based on some longevity and some time of continuously funding any kind of an account in the amount of $30,000, and it looks at 1 to 50 years based off of different rates of return, either 3, 5, 8, 10, and 12% returns, and gives you just kind of idea that it doesn't take very long, certainly at these levels of contribution, to actually grow to some sizable net worth. Um, but that's something that helps you get a good look at the power of compounding and the power of continually making contributions into your paying yourself. And that's what you're trying to do, is to get your bills paid but live a little bit conservatively now so that you can actually live much more comfortably later in your years. So let's jump down here to the next section, pay living expenses. And paying your living expenses is another outflow. And this basically can be viewed as your operating costs of running your household or your home. You are looking at shelter costs, which include your mortgage, insurances that pertain to the home, utilities, stuff like that, any maintenance and repairs. And let's just say that since we've already allocated 10% up here to charity and then 20% we're paying ourselves, let's say that we're going to take 50% of our total income and pay that towards our living expenses. So by doing that, now we have to allocate that by the categories that have been pre-assigned here. Shelter, let's say, is 25%. So that means by taking 25% of our budget for living expenses creates a $1,563 contribution to pay for mortgage or rent, to pay for utilities, some maintenance items, and maybe that's too low. Maybe we should jump that to 30%. Okay, so that's $1,875 now. So now we need to household budget of groceries and that type of thing. Let's say, let's go 10% here. And again, we're trying to get down to a 40%. And some of these, either you know of the percentages yourself or you know of your dollars that you're paying. So it's pretty quickly you can work and massage those to get to your 100% spent. And just think of that allocation as spending. So for the sake of this, let's just go 10, 10, continuous improvement 5, 5. I mean, taxes could be 30%. This is already 100% now. There's no leisure budget, obviously. So let's jump that to 2, 2, and 6. Our health costs probably a little bit high. Let's go 8 and 8. So now we've allocated, just with this quick, you can see how fast you can work through those numbers just by managing and massaging those numbers. And that takes the 50% of your $150,000 salary, which is 75 grand, and it's allocating it based on these different percentages, based on these different categories under paying living expenses. Now say that you think that this is too low, we need to have more money into this account, and jump that to 60%. I mean, it will just automatically, based off of this grouping of percentages, just automatically increase everything by whatever this factor is. So it moves very quickly, and if you think that these percentages now are out of line, make your adjustments there pretty quickly. But for this sake, we are going to leave this at 50%. So that 50% now shows down here as we build through this. It summarizes the totals on the bottom. Income total is at 100%, of course. That's what we're starting out with. We've given 10% to gifts and charity. We've given another 20% to ourselves, or paying ourselves. And now we've given 50% to our living expenses. And what's left are any creditors or debt. And the creditors could be auto loans, it could be medical bills, it could be student loans, it could be credit card debt, anything that you're dealing with. So let's assume that we have our final 20% added in to pay our creditors. Now on the bottom, you look, we have there's 100% calculated down here for a sum total, and that's what we have up there. So all of our money has now been allocated to one of the classifications, be it gift, savings, living expenses, or creditors. So now we just have to allocate this last 20%, and let's just pull up some creditors here. Some medical bills, um, credit cards, credit card XXXX, whatever credit card is that you're using that you have to pay off. Let's say auto loan. And you have a choice here too. You can put your auto loan here, or you can actually put it up here too under your transportation. Just don't double up on that in case you are. The shelter and the mortgage is already added in there. So pick one of the two. Um, and let's say student loan. So we have some bills here that we want to pay and let's just, what we do here, unlike what we've done up here, we don't add in the percentages. You can see they are not highlighted, but over here we have a monthly payment and the balance that's outstanding. So we track that a little bit differently because what we want to do, we have said that we don't want to pay more than 20% of our income to any creditors. Whatever we do, we want to live off of 50, we want to save 20, we want to give away 10, and we want to use 20% to pay our bills off, our creditors. So you need to learn it's very simple to get into that habit of grouping that way. So let's just say we have medical bills of $12,000 that we have to pay, credit cards of $5,000, we have an auto loan of $12,500 left, and we have a student loan of $25,000. Okay. Now, out of all these monthly payments, we only can pay out $2,500 a month out of this. So you have to arrange to make these payments allocate only the $2,500 and no more than that. Hopefully that's already been done, but what we try to do is to create a certain set amount in your mind that you can, and it's called a budget, so that you cannot overspend that, and that'll help you in each of these categories zero in on what you really have to spend. If your earnings change, you can change your budget up or down, but you want to make sure that you have obviously reserves saved up. If your income changes, you live off of that reserve, and you also don't want to spend more than what you're bringing in. So this actually creates a minimum amount you want to have on hand through the savings, but also keeps a ceiling on what you're allowed to pay out in the way of making new purchases or financing purchases. And it also keeps in track what you're paying out in living expenses too. You can see quickly if you're over budget every month. The monthly totals are right here. You can see exactly what's going on. And if you want to go do a certain something, like go on a vacation, do you have the funding for that? You can quickly zero in on that. So let's quickly allocate the monthly payments to our creditors. Medical bills, and again, some of these you may call and you may be able to adjust. Others you probably will not be able to adjust. So maybe we should start with the auto loan. That's pretty much a fixed. And let's just say that we're making a payment of $300 a month. So what that does is takes $300 of this $2,500 and deducts it from the monthly. Here's the remaining balance. So it takes the $2,500 here minus the $300, leaves a balance of $2,200. And what this formula also does, it looks at how many payments you have left that are due at $300 a month, just to give you a kind of a total of what's going on before that balance reaches zero. Our medical bills, this may be something you can call the negotiate, or you should be able to negotiate this one. Let's say we're paying $150 off on this, or maybe it's, for right now, let's just say $150. You can see that calculated out to eight months, and that's almost, 7 years? And that might be a little long for your creditor to wait, so maybe you're doing 250, or maybe it's 302. Let's just say 325. Now we're down to $1,875 that's left to spend on this. Say our credit card is 1,000, and let's say our student loans are 870. Let's say our student loans are 500. So now, for easy and quick figuring, this looks at the total amount here that's owed, outstanding debt, which totals up to be $54,000. It looks at the total amount here, which is $2,125, that is being paid out monthly. So you take the $2,500 monthly budget that you've allocated, you pay out these 4 expense line items, and you still have a $375 balance left out of that budget. So eventually, if you follow these numbers exactly, you would actually be accumulated in your accounts the extra 375. And what this does, this takes this excess unallocated funds from the budget percent and moves it up here to your investment area, up to pay yourself, invest excess funds from pay creditors below. So I brought that 375 up here, and it's just accumulating that every month and acts as an investment, and that rolls down into these other numbers for calculation. Now technically, if we're doing that, we probably want to, you're probably being charged interest on these medical bills, so you probably want to adjust that. So you want to clear that out, and you can see if you zero that out, this now becomes $700 that's left. So we'll just quick put that up there, and that zeroes out all of the money. So now you have the full $2,500 of your allocated budget for the pay creditors line item is being spent on these 4 areas. So now these bills are all being taken care of, and what this looks at too, since you have these payments and the remaining number of payments before the balance hits zero is calculated, it looks at all of this and says that at $2,500 a month, that $54,500 will be paid off in 21.8 months. So it's just a little under 2 years, and at this payment program, you'll pay that debt down in 2 years, assuming no other debt and assuming no interest costs. But that gives you a quick little planning tool, and that's what this is all about, is planning. This also right here, this section has a little formula in it that if this actually, let's change that to 9, it'll tell you that your pay living expenses are out of balance. The total should equal 100% right here, and it equals 99. So go back and change that. And now it says 100% of your pay living expenses have been allocated. Just a little extra something in there. And down below, this does calculate your weekly earnings and your monthly earnings after taxes, and it's based off of your taxes that have been put in right here. It's taking that 30% out up above. And we just want to show that in case you're working off of a cash flow and it's just depleting, you want to know what your money coming in, what your paycheck amount is actually going to be if you're looking at it from that perspective. But you don't want to forget your taxes either, because sometimes you're paying in too much and getting a refund, and maybe you like that as an IRS savings account that you get back every April when you file your taxes. But if you budget appropriately and stay on this and reconfigure your budget occasionally, and if you're a husband-wife team, it's good to sit down together and talk through this so that you both know approximately where you're at. And this is a very good worksheet and a work program to go through. And again, this is a Microsoft Excel spreadsheet, excuse me, and this is a budget spreadsheet. And we also, LifeLongU also creates a spreadsheet that is for actuals that ties into calculating these categories by line item. So you can see what really goes into shelter and household, transportation, health, continuous improvement, and so on as you walk through there. And that creates a dashboard of actual expenditures and compared to your budget. And we will be offering that too shortly with a tutorial on how to load that. So you will be able to calculate your budget and then look at your actuals and fine tune that, and they'll get down to these percentages off of the actuals spreadsheet when you go through that dashboard creation, and then that'll help fine tune these areas a little bit more. And it's very simple to go through this, and we hope that you use it. And if you have questions, please don't hesitate to contact LifeLongU and just email coach@lifelongu.com. And somebody from our office will make sure and get back to you. Thank you